If you have one extra dollar to put toward retirement, should it go into your 401k, a Roth IRA, or somewhere else? In 2026, the IRS allows up to $24,500 in employee 401k deferrals and $7,500 in total IRA contributions, subject to the rules and limits that apply to you. But the biggest limit is usually not the IRS limit. It is your cash flow. In this video, I will give you a simple order for choosing between a traditional 401k, a Roth 401k, and a Roth IRA. We will cover the employer match, taxes today versus taxes later, contribution limits, investment choices, and the mistakes that make people choose an account before they choose a plan. This is general education, not individualized investment or tax advice. Here is the short version. If your employer offers a 401k match, learn the plan rules and consider contributing enough to receive the full match if it fits your budget. After that, a Roth IRA may be attractive. If you are eligible, you want more investment choices, and paying tax on the contribution today fits your situation. Then you can increase your workplace plan contribution or use a taxable brokerage account after handling your emergency fund and expensive debt. That is a framework, not a universal command. Your tax bracket, income, plan fees, debt, and goals matter. A traditional 401k is an employer-sponsored account. Contributions generally come from payroll before income tax, subject to plan rules. The money can grow tax-deferred, and withdrawals are generally taxable later. The immediate tax deduction can be valuable when your current tax rate is high, but the deduction is not free money. You are choosing to delay taxes, and future withdrawals may be taxable under the rules in effect then. The other benefit is scale. The 2026 employee contribution limit is $24,500, much higher than the IRA limit. Your employer may also add matching or other contributions. The trade-offs are plan-specific investment choices, fees, and withdrawal restrictions. Read the plan fee disclosure and investment menu instead of assuming every 401k is good or bad. A Roth IRA is an individual retirement account funded with after-tax dollars. You do not receive the same upfront deduction as a traditional 401k, but qualified withdrawals can be tax-free under the rules. The 2026 IRA contribution limit is $7,500 across traditional and Roth IRAs combined before catch-up rules. Direct Roth IRA contributions also have income phase-outs. For 2026, the phase-out range is $153,000 to $168,000 for singles and heads of household, and $242,000 to $252,000 for married couples filing jointly. The Roth IRA can offer a broad investment menu and flexibility, but eligibility, contribution limits, and withdrawal rules matter. Do not assume every withdrawal is tax-free just because the account is called Roth. A Roth 401k and a Roth IRA both use after-tax contributions, but they are not the same account. A Roth 401k is inside your employer plan and uses the larger 401k contribution limit. It may have fewer investment choices and plan-specific fees, but contributions are convenient through payroll. A Roth IRA is opened individually and may offer more investment choices. It has the smaller IRA limit and income eligibility rules for direct contributions. If your employer offers a Roth 401k, compare the plan fees and investments rather than choosing based only on the word Roth. A traditional contribution can be attractive when reducing taxable income today is valuable and you expect a lower tax rate later. A Roth contribution can be attractive when your current tax rate is relatively low, you expect higher income later, or you value tax-free qualified withdrawals. No one knows future tax law with certainty. You are creating tax diversification, not predicting the future perfectly. Use this order as a starting framework. First, cover essential bills and build an emergency reserve appropriate for your situation. Second, reduce high-interest debt that is working against your savings. Third, contribute enough to the 401k to capture an available employer match if that fits your budget and plan rules. Fourth, consider a Roth IRA if you are eligible and the account costs and investment choices work for you. Fifth, increase your workplace contribution toward your long-term target. The IRS allows catch-up contributions for eligible older workers, including a higher limit for certain ages 60 through 63 in 2026. Sixth, consider a taxable brokerage account for goals that come before retirement or after tax-advantaged accounts are handled. Do not ignore a 401k match while chasing a perfect account. Do not max an account while carrying expensive debt and having no cash for an emergency. Do not choose a Roth IRA without checking eligibility and contribution limits. Do not roll money into an account without understanding fees, investment choices, and tax consequences. And do not confuse the contribution limit with a goal. A limit is the maximum allowed, not an amount everyone should contribute.
Here is a simple 30-day plan. This week, open your employer plan and write down the match formula, fees, investment menu, and current contribution rate. Next, check whether you are eligible for direct Roth IRA contributions and confirm the current IRS limit for your situation. Then calculate one realistic monthly increase. It could be 1% of pay, a fixed dollar amount, or a contribution timed to your next raise. Finally, automate the change and review it after 1 month. Increase gradually when your budget can handle it. The best account is not the one with the best slogan. It is the account combination you understand, can fund consistently, and can keep invested through normal market uncertainty. Subscribe for practical U.S. finance videos. Comment retire if you want a retirement account checklist next. This video is general education, not individualized investment, tax, legal, or financial advice.